Let's welcome in our next guest. David Stryzewski is with us, CEO, Sound Planning Group. Thanks for being with us, David. Your thoughts? I mean, the markets, we've gotten a lot of tech earnings. What's on your mind?
Hey, good afternoon, Nicole. Great to be with you as always. Yeah, we've got tech earnings in here. And just as you've been going through, if you can beat earnings or analyst expectations, you're rewarded for that handedly. It's just that we've got quite a mixed bag right now going on between, some of the challenges there at First Republic. And, I think it's very important that we understand that if we see that challenge and that failure, which would be horrible, obviously, how would that impact the tech community who ultimately have charters to bank with this specific bank because they IPO'd with them? There's some very, very, very important things that we need to be looking at. Love the fact that we've got, this AI revolution going on. It's obviously fascinating. Obviously, there's a few scary parts to it as well. But Microsoft's a home team here. We've been bullish on them for a while, and I think that they've got a lot of runway left, looking at some of the, the subscription-based things versus, maybe where Google goes into more of the tracking as they're doing search engine optimization and whatnot. And so anyway, there's quite a number of things to be paying attention to, but I think that we're kind of sitting at a moment that might be considered the calm before the storm, if we're looking back here a few months from now.
Calm before the storm. That doesn't sound particularly good. Do you think some of this relates to not necessarily First Republic, but what happens afterwards? Because I just checked the low of the day here. It was $4.76. I mean, this was a $170 company not that long ago.
Right.
And now the government saying that they're not willing to step in. Not sure you're going to find a buyer so fast. I mean, we've had names like J.P. Morgan. You remember J.P. Morgan with Washington Mutual and Bear, and basically saying, never again are we doing that. Right. We'll help out on the side, but not willing to do takeovers and then pay penalties later. What do you think happens here, and why is it important?
Well, it's I think very important to understand, what's actually taking place in the banking industry. So if we go back to 2008. These banks had some new regulation that said that they don't have to mark to the market the treasury bonds that they hold. And so this is really where things got out of hand here, is where, they had these treasury bonds, they were down, 20-30% because the interest rate changes. And this is really the catalyst. The cost of capital has gotten so expensive here because of the moves that Powell has made. And so they get a run on the bank and they're forced to liquidate those positions. Well, I personally think that it would be a big mistake for investors today to think that we're out of the woods on a banking crisis. So I've been saying this for a while. I think it's important to note we've just finished the first month of our banking issues so far. It took over a year before Washington Mutual, Bear Stearns, Lehman had their full effect and challenges there. What we really need to understand is what are the impacts? And so I'd say that you look at the local regional banks, which metabolize 70% of corporate debt, whether it's the office space that I'm currently in right now, or it's the debt that's needed for organizations that IPO'd or SPACs that need more capital to ultimately run. We don't have the same rate environment as we did previously. And so as people are doing more of a work from home right now, and office space and vacancies are going up. I mean, my goodness, I was in New York and I was appalled by how quiet things had become as the city's hustle and bustle was ultimately changed post this 2020 timeframe. And so I think it's really important that we understand, okay, if these challenges happen, if these local regionals don't have as much cash to lend out on the 10-to-1 basis that they were before, where's this lending going to come from? If I put money in the treasuries today, I don't have FDIC limits of 250. If I do it for longer than a year, I've got long-term capital gains versus 1099 income. We've got the Treasury's full faith that says that they're backing this up. There's a lot of pressure on these banks here today. And so I don't think that we're out of the woods. In fact, I think that it's ultimately going to erupt at some point here. And we could find ourselves with a lot of Chapter 11s going forward, where businesses will be forced to remetabolize their debt. They'll have to go back to creditors and say, hey, we can't make the payments at these rates, but we still have an organization that's still working out. Make a deal with us here before we have to fold up and not pay anything back. And so again, this is my worst fear. I don't vote that this idea happens. I just am someone that's looking at this objectively and trying to say, okay, what are the ripple effects if we begin to find ourselves with these losses, these challenges, because the Fed just flipped the entire world and how we operate. And I think the damage has been done, and we're going to be finding ourselves a couple months from now looking back and saying, wow, that was unexpected, because these things tend to happen really quick. You know, when Silicon Valley Banks falls apart in 2 days time frame, that was the fastest ever.
Yeah, no, it was a very, I remember that Friday being very uncomfortable. And so let's spin it forward here for investors.
Yeah.
I know silver and gold is something on your radar. You also are looking to something like Microsoft and AI. I mean, Microsoft has been a great performer, great for shareholders over the many years. Why Microsoft? Why gold and silver?
I think it just so starting with Microsoft, we just have to understand how the world has changed. COVID entered in this whole, work from home idea. I mean, at my firm, that wasn't even really an option prior to COVID. And now that's an option that's definitely out there and exercised. So now we've got less banking challenges, or things that are going on in the office space. So I think this also brought a lot of tech adoption. Zoom, as an example, became this, massive revelation. It had been around for a while, and it's like, wow, we can actually do appointments this way. And, we got Slack, et cetera. Well, Microsoft Teams has obviously worked out very well, and Google's obviously done pretty well here too during this time frame. And so I think it's important for us to look at Microsoft and say, okay, adapted during COVID, have some of the new ways that we're going to be doing business, and now this AI revolution, it might replace some jobs. But I feel like, the toothpaste is out of the tube. This is a very, very, very real idea, and it's going to continue to go forward. Getting to silver and gold, the United States dollar is not looking as pretty as it once was. The fact that we've got this deficit that hasn't even been really discussed, and we're about a month or so from completely defaulting. I mean, we're past our moment. Now we're can we continue to still pay our bills with the remaining cash that's here? So I think they're going to get a deal done. But if we get back to quantitative easing again, because banks have challenges, or God forbid, cities and states start having issues, this is where we need to understand, what have the world bankers been doing? Well, they've been buying gold by the tons, and they've been buying gold by the tons more recently in just escalated ways. So I personally look at the ratio between silver and gold and think that that's an important one to identify. They can mine 9 ounces of silver for every 1 ounce of gold, but the ratio is somewhere around 80 ounces of silver for 1 ounce of gold. So supply and demand would dictate that there's an imbalance there. Plus, silver ultimately has this, commercial value associated with, connecting chips and TVs and all the other wonderful things. So I think that we're going to see a pretty significant run in silver. In fact, probably my favorite idea for the next probably 2 years or so. But it would probably also be a pretty good hedge if this Cold War in Ukraine, Russia, and China becomes more of a hot war. The BRICS nations trying to establish their own currency would be, a very unfortunate reality. And now France is ultimately trading natural gas in the yuan and not the United States dollar. So if we're paying attention right now, a lot of things are slipping and changing. And I think that the average person can recognize those ideas and really, position themselves for success here if they take some alternative ideas and thought. And the last point I just want to make on this, Nicole, is that I'm pretty concerned actually about the bond market. And I know bonds are safer than stocks, quote unquote, but there's 5 different ways that bonds can lose money. And so that's a revelation that's critical to understand. So the interest rate changed when interest rates go up with the Fed. The value of the bonds went down. That's part of the problem that the banks have now, and as well as every pension that's out there. But also we need to understand that bonds are losing to inflation today. So that's a guaranteed loss. If your advisor's charging you on top of that, then you can, depreciate your net present value even more. If we see something that was credit worthy go to junk status or less credit worthy, that's going to be costly. We also know that supply and demand has big issues with it when the sellers want to sell more and the buyers want to buy. So as we begin to see more challenges happen, and again, I don't want to be bearish. I just feel like it's important to understand that as seasons change, we probably need to address the way in which we're, let's just say, dressing for the climate. You know, if it's warm outside, I'm going shorts and a t-shirt. It starts getting pretty cold. I think it'd be wise to put on a jacket and some pants and some boots and some gloves, maybe, and a hat. And again, I think we're heading into this summer right now, and some of this is just beginning to deteriorate, just like most of the U.S. CEOs as well as global CEOs believe that a recession is developing, but also a financial crisis at the same time.
Okay. And that's why you're looking to silver as your best pick, one of your best picks for the next couple of years, you said. David Stryzewski, CEO, Sam's Planning Group. Thank you so much, David. Thanks.